Section 13, Impact of Market Cycles on Default Rates. Don't default. A few weeks after discussing the housing crisis, Melissa was meeting with a young couple who wanted to purchase their first home. As they reviewed financing options, one of the buyers asked a thoughtful question. If the real estate market is doing so well right now, why do people keep talking about preparing for the next downturn? Melissa smiled. That's actually one of the most important questions you can ask. She invited David into the meeting. David drew a large circle on the whiteboard. Real estate markets move in cycles. They always have, and they always will. No market expands forever, and no recession lasts forever. Understanding these cycles helps realtors better advise clients without trying to predict the future. He divided the circle into 4 sections. Every market generally moves through 4 phases: expansion, peak, contraction, and trough. He pointed to the first section. During the expansion phase, the economy is growing. Employment is strong, wages are increasing, and consumer confidence is high. Home values typically rise. Lenders are more willing to make loans, and homeowners often have enough equity to refinance or sell if financial difficulties arise. Because borrowers generally have stable employment and increasing income, mortgage default rates remain relatively low. Melissa nodded. So when the economy is healthy, fewer people lose their homes. Exactly, David replied. He moved to the next section. The peak phase is when the market begins slowing after a long period of growth. Home prices may still be increasing, but at a slower pace. Inflation may rise, causing the Federal Reserve to increase interest rates. Borrowers with adjustable rate mortgages may begin seeing higher monthly payments, and financially stretched homeowners may start experiencing difficulty making payments. Default rates often begin increasing slowly during this phase. Melissa asked, "Is this usually when warning signs begin to appear?" Yes. Experienced professionals start paying closer attention to economic indicators instead of assuming the market will continue rising forever. David then pointed to the third section. The contraction phase, commonly called a recession, is where defaults often increase significantly. He explained that layoffs, business closures, reduced consumer spending, and declining property values create financial pressure for many homeowners. Some borrowers lose their jobs entirely, while others experience reduced work hours or lower income. At the same time, falling home values may leave owners with negative equity, meaning they owe more on their mortgage than the home is worth. Because lenders also tighten lending standards during recessions, refinancing becomes more difficult, leaving some borrowers with limited options to avoid foreclosure. Melissa looked at the buyers. This is why realtors encourage buyers to purchase homes they can comfortably afford, not simply the most expensive home a lender is willing to finance. David smiled. That's protecting the public. He moved to the final section of the circle. The trough phase represents the bottom of the market cycle. During this period, foreclosure activity and bankruptcy filings may remain elevated, but the economy gradually begins stabilizing. Government assistance programs, foreclosure prevention efforts, lower interest rates, and improving employment conditions often help reduce default rates. As consumer confidence returns and businesses begin hiring again, the housing market slowly starts recovering, beginning the next expansion cycle. One of the buyers raised another question. What if someone believes their lender has acted unfairly or even committed fraud? David answered carefully. That does happen occasionally, and borrowers have rights. He explained that borrowers who believe they have experienced deceptive lending practices should carefully preserve all loan documents, payment records, emails, and written communications. They should request explanations from the lender, seek advice from a qualified real estate or consumer protection attorney, and file complaints with the appropriate regulatory agencies when necessary. Depending on the circumstances, agencies such as the Consumer Financial Protection Bureau, CFPB, Federal Trade Commission, FTC, U.S. Department of Housing and Urban Development, HUD, the Arizona Attorney General's Office, or banking regulators may investigate alleged misconduct. Realtors should avoid investigating legal claims themselves and instead direct consumers to the proper resources. Melissa asked one final question. Does Arizona have laws protecting consumers from predatory lending? David explained that Arizona provides consumer protections through several statutes, including the Arizona Home Loan Protection Act, ARS Section 6-1141 through 6-1143, statutes regulating mortgage brokers and lenders, the Arizona Consumer Fraud Act, ARS Sections 44-1521 through 44-1534, and Arizona's anti-deficiency statutes. Federal laws such as the Truth in Lending Act, TILA, the Home Ownership and Equity Protection Act, HOPA, and provisions of the Dodd-Frank Act also provide important safeguards designed to promote fair lending and transparency. While realtors should recognize these protections, legal interpretation and enforcement remain a responsibility of attorneys and regulatory agencies. As the meeting ended, Melissa reflected on everything she had learned. The real estate market would always experience periods of growth and decline. While realtors cannot prevent economic cycles, they can help consumers make informed decisions, recognize warning signs, and understand available resources if financial hardship occurs. Professional guidance, ethical conduct, and consumer education remain some of the most valuable services a realtor can provide, regardless of where the market happens to be in its cycle. In the next section, we'll begin shifting from foreclosure and market risk to practical solutions by exploring how realtors can help homeowners evaluate alternatives before default becomes foreclosure.